Good evening, everyone. So we've all assembled here for interesting discussion on securitization market. So year 2017 has been a watershed year for the market in many ways. So one is that the issuance volumes reached at an all-time high of 90,000 crores. Our own estimate is that PTC volumes were around 43,000 crore, which was a growth of almost 76% from the previous fiscal. Also, the direct assignment market grew at a healthy pace, and again, our estimate is that the volumes were close to 48,000 crores in the last year. So if you look at the PTC and the DM volumes taken together, the volumes were 90,000 crore, which is no mean number. Also, there were some positive developments on the regulatory side as well. So FIIs were have now been allowed to invest in short-term securitized paper. So this opens up the market to a newer segment of investors, investor segment that has deep pockets, and it only augurs well for the market in the years to come. Mutual funds again made a comeback into the securitization market after lying dormant maybe for another past 3-4 years, and this came about because of the tax-related concerns getting addressed, thanks to distribution tax being replaced with withholding tax. However, some issues continue to persist. So the market is still burdened by PSL overhang. Mr. Khan touched upon this very briefly earlier. So our own estimate is that 88% of the PTC volumes, and if you include direct assignment transactions as well, then the number would be lower, but fairly high still at around 75%. So around 75% of the market still continues to be driven by PSL-related demand. And if the market has to see consistent, sustainable growth in years to come, then obviously the reliance on PSL has to come down. There is also some uncertainty in the minds of market participants. So this is on account of what will be the impact of the new accounting standards that become applicable for all financial sector entities starting next year, and also on account of the GST regime, so what impact it would have on the market volumes going ahead. So with this backdrop, I think it's an opportune time for us to be having a discussion on all these issues that I mentioned, and who better to do that. We have a distinguished set of panel members here, good representation from the investor segment, from the issuer segment, and we have Nihas as well. So I am very excited to hear what the panel members have to say. So without further ado, let me just quickly ask the first question to Nihas. So Nihas, there has been some concern that transfer of receivables to a trust, and especially the secured receivables, may be subject to GST levy. So what are your views on that?
Sure. So I think, yeah. So just to understand where the issue is coming from is, right now GST is a supply-based tax, and they've said any kind of supply for a cash consideration is subject to a GST levy. And they've also set out a list of exemptions in relation to transactions which will not be governed by GST. One of the exceptions is this term called actionable claims. Now, actionable claims is a term which is defined under the Transfer of Property Act, and which originally meant any claim to money is an actionable claim. However, Transfer of Property Act itself has been amended long back, which excluded secured debt from its ambit. So therefore, now you have an exclusion from GST for actionable claim, and the converse is that, therefore, secured debt is subject to GST, is the interpretation that comes out of it. This definitely cannot be the intention, that a transfer of a secured debt should be subject to a GST, while a transfer of an unsecured debt will not be subject to a GST. Definitely not the intention, and we expect a clarification to come for sure on the subject, and people have already been speaking to the ministry, etc., on this, and we expect a clarification to come. Even, worst case situation, even if a clarification doesn't come, this is something that can be easily struck down by the courts, as not being as being kind of arbitrary, because it makes a distinction between transfer of unsecured debt and secured debt without having any basis. So therefore, I mean, even if the lawmakers don't do anything, it's something you can always approach the court and get it struck down. So while the issue exists, I don't think that was the intention of the lawmakers.
Okay. So yeah, so for the benefit of everyone, I do hope that that clarification comes quickly. Also on repo and sale of assets, again, how would the new tax regime work? And also, is there a distinction between repo and sale of movable assets as opposed to immovable assets?
So I think as far as repossession is concerned, as far as housing finance companies are concerned and retail loans, you're absolutely in the clear. There's no additional GST which comes in when you're looking at a repossession and sale of dwelling unit or residential property, anything of that sort. So, however, that similar exemption is not there when you come to movable assets or when you come to even under construction loans. So when you look at your construction finance portfolio, etc., all of that, any kind of transfer of those assets will kind of have a GST impact, and that GST impact might have to be borne even on the lender repossessing and selling. So just to give some background before getting into the immobile property bit was, under the VAT regime also, many states have levied tax on the NBFCs in relation to the repossession of vehicles and sale of the vehicles, saying that that is a sale by a dealer under that regime, under the VAT regime. So therefore, it's the same, it's a similar principle that has been taken into the GST also, and they've very categorically said that if a financer is repossessing a vehicle and selling, it will be subject to a GST levy. And it's added a layer of confusion because the VAT regime applied on a sale and the GST regime applies on a supply. And the fact that so let's take an example of a vehicle. The vehicle is being taken over by a servicer in a securitization transaction. He's taking it on behalf of the trust. So therefore, there's a deemed supply of the vehicle between the trust and the servicer, and therefore there's a confusion whether the taking of the repossession itself becomes a taxable event. And again, clearly this was not the intention. The intention was just to carry over some of the arguments from the VAT regime into the GST principle. Therefore, it should only be only the sale that should be considered. However, that confusion still exists, and people are trying to formulate opinions, and I mean, in-house view is still that this cannot be the intention, but how do we figure a way out is still something we're looking at. So for mobile assets, definitely repossession and sale has a GST impact, and it will have to be paid by the lender. Vis-a-vis immobile assets, where especially your retail, where your construction is complete, the residence is already commenced, etc., all of that, there is no GST impact on a transfer of immobile property, which is where construction is complete and occupation is commenced. Under construction, you still have an impact.
Good thing is that securitized pools obviously have that benefit that you can only include contracts where full disbursement has happened. So I think at least for mortgage loan transactions, that concern would not be there. So I'll move to Ashwini next. So Ashwini, we've seen that banks are increasingly looking to source PSL assets on their own, be it through direct sourcing by expanding the reach, opening more branches, or through the BC channel. We've also seen incidences where banks have either acquired some MFIs or having even some interest in acquiring MFIs. Already, Shriram Group being merged with IDFC is making news. So in this backdrop, do you think that the demand for PSL assets would come down in years to come?
So my sense is, while PSL assets dominate the securitization market and hence are very important part of the development of this market, the requirement of PSL of banks have only gone up. If you look at, from the largest lender to the country to all the private banks and foreign banks, we continue to see huge demand coming on the PSL. So I don't think so there is any challenge for originators like us to have a situation where all the priority sector asset that we are originating have no market for them. To give you a perspective, last 2 years have been tough in the sense the credit growth in the system has been low. And on further RBI reprieve which came for banks was that any investment in rural infrastructure development fund with NABARD will now continue to qualify as PSL for subsequent year. So both things, low credit growth plus some amounts and huge amounts in RIDF, RIFDF now continue to qualify as priority sector, had reduced the requirement of PSL loans by a large measure. But we still could sell at a very good quantum in both FY 15 and 16, and so was the case with most of the lenders. And now with increased requirement, let's say for foreign banks, and continuous portfolio growth by private banks, I believe the requirements will continue to inch up. It's a good initiative that the last mile reach is being incorporated through, let's say, acquisition or alliances with these NBFCs or microfinance players. It will only help banks which have largely been seen as wholesale lenders to have last mile connectivity and hence be able to fulfill most of their requirement by themselves. But for originator like us, we find requirements from the industries way more than what we can supply to them, and I don't see this situation changing anytime soon.
There is also a view that with some of these SFBs now becoming operational and they having obviously the flexibility to issue priority sector lending certificates as well to leverage on their own PSL asset base. So do you think from a supply point of view, there would be a greater supply of PSLCs in the market? So could that eat into the PTC volumes and could that have an impact on the securitization volumes?
So again, the pass-through, PSL certificate are definitely a good innovation for the system as a whole. One, they incentivize banks who already met their priority sector target to do more if they can, because they can always sell certificates against those assets and earn some fee-based income. Two, there is no exchange of assets, so they don't need to sell their own assets, which would typically hamper, because let's say these are marginal farmer loan or agri loans where delinquencies are high. So the other bank would have been in the past reluctant to take these loans from these issuers. So as a system, it's a positive development. It's a frictionless system. For the market, from a securitization perspective, definitely it eats into it. But my sense is the quantum that we saw, let's say in FY 17, the regulation came only in April 16. So 11 months have given a volume of around 25-30,000 crore. So I think the requirement of priority sector and the sense I'm getting that a lot of public sector banks, large public sector banks, are also seeking to buy priority sector loans from us tells me that the requirement is way more. And now we are seeing some of the foreign banks who are reluctant to take anything else than those 2-3 year maybe commercial vehicle type of loan have got approval internally for tenors on, let's say, loan against property or SME loan as long as 10 years. So, and more foreign banks are approaching us that they can buy not only the home loan pools, but the SME LAP pools also. So this only tells me that the market for priority sector asset is growing, and hence most of these transactions will happen in a securitization PTC structure. So market will only develop around these products.
Thank you. So my next question is for Prasann. So mortgage-backed securitization transactions ideally should be a good fit for any insurance company as an investment. considering the long tenor of the underlying assets, relatively secure asset class. Traditionally, the losses and delinquencies in the segment have been low. In the past, we've seen LIC investing into some of these MBS papers, but of late, insurance companies have stayed away. And it's been a good 12 months or more than that since the taxation issues have been addressed. So what is the reason why insurance companies are still not investing in securitized debt?
I guess the first reason is that at least we haven't been shown a transaction for the last 5 years. Let's be fair on that. So really, we haven't refused a transaction, just we haven't seen any. I think let's look at some of the basic construct of some of these transactions. Agreed, from a credit perspective, we are very comfortable with the asset class. There should not be an issue. But I would dispute that long-term connotation to the asset class. I mean, even if the loan is a 15, 20-year loan, eventually given the prepayments, the tenor of the loan is actually much shorter. So therefore, it's not really a long-term asset class. So it's very difficult for me to take this asset and put it against my long-term liability. So that is one basic issue which comes through. It is an illiquid asset class, so it cannot be a part of a certain part of my portfolio. Third issue which comes through is that end of the day, these are still floating rate loans. And my liability is all fixed rate. So it again causes a bit of dissonance as far as the matching of the assets and liabilities is concerned. Put all this together, and obviously till last year we had the tax issue. And though that has been resolved to an extent, it hasn't really been utilized. So we haven't seen any of these transactions really coming through. So would we as an insurance company be interested in looking at these transactions? Sure, we would be interested in looking at these transactions, provided we get us a better hang in terms of some of the issues I talked about, and also the pricing. End of the day, the pricing one, as an investor, I would look at, this has to be better than a similarly rated bond, as far as I'm concerned. And in the past, we have seen that there is always this challenge of the pricing which the issuer is seeking from their perspective, and as an investor, what I'm really looking at, and the twain sometimes doesn't really meet. I think these are some of the challenges why I think no real transactions on the MBS side have happened over the last 12 months, if I put it that way.
Okay. So my next question is to Mr. Bala. So you've been one of the largest investors, at least in the non-PSL space, and you were the first one to enter into the PTC market after the market restarted, at least for the mutual fund investors. So what are the benefits that you see for investing into securitization transactions? And what are the reasons why, still all said and done, mutual fund investments, I think, were only around 5,000 crores in the last year. This is loose change in relation to the overall debt AUM of the industry. So why is it that the volumes continue to remain so small?
Clearly, of course, thanks to what you're mentioning, that we took a lead. But if we can look at the history, the early days of 90s when securitized paper market was picking up, mutual funds were one of the largest investors in securitized market. And one, because it gives the diversity, because we actually, industry is going and actually lending into large pool of retail customers, it's next to impossible. So the only the way we can participate in the larger pool of assets is only the securitized market. And that's why we were big, and then of course, thanks to that taxation restriction which came, the mutual fund industry went into a shell. And now it actually is coming back. And when it came back, of course, since we have been one of the leading players even in the past when securitized paper market used to be active, actually we could come back and look at this segment more proactively. And that's why I think Bilasal Mutual Fund took the lead in that. The very fact the mutual fund industry's fixed income assets is growing. And one of the asset class actually is the fit the bill pretty nicely. Is securitized paper market. Once the average maturity of these instruments generally varies between 3 to 3.5, 4 years. And most of the mutual funds operates in that 3 to 5 years kind of segment from the maturity portfolio maturity's point of view. And second, it gives you diversifications, which otherwise I don't get the diversification of single security exposure, single company exposures. We don't get the diversities. We are straightaway we are getting actually large pool of diversification through these means. And third, of course, is the collateralized. I think when you look at the underlying credit quality, though we may probably see some kind of accidents in the underlying portfolio, the way the PTCs are structured with high governance, high collateral, And that also gives additional cushion actually from the investment's point of view. Therefore, it fits all the bills. And third, of course, is actually is when as against investing in a direct exposure to a corporate of the same company, if I actually look into the PTC route, you get about 35, 40 basis points, maybe 60, 70 basis points, sometimes extra yield kicker, which again helps in terms of generating additional return. At the end of the day, we all operate in a competitive environment and look at the peer group return, and this kind of instruments that definitely provides an opportunity to generate the extra return as well. And that's why I think we as a mutual funds have taken a lead in that. And apart from that, which we have realized internally, we have seen in the past, when I used to be a money manager, active money manager, when we used to invest in securitized papers, we used to have a large pool of even prepayment as well. There used to be a time we had to go and tell the issuers, say, I can't take such a large prepayment. So that's actually, it's a good as well as bad. Sometimes it's bad, and it's also good because it reflects that credit quality of the portfolio is far better, therefore you're also getting a prepayment. And for which one need to do a very clear analysis. So what we have done at Birla Mutual Fund, we have actually dedicated a person only to actually focus on analyzing the underlying portfolio on multiple cuts in terms of whatever the seasoning is done by you as a rating agencies. We also, of course, do a double check at our own level and see to it that you do actually bring in the necessary research and underlying the portfolio before bringing on the table. So that's where I think we have taken the lead. But I'm told the industry size is about close to about 9,000 crores, and Birla Mutual Funds owns about roughly about 3,500 crores in this space.
Okay, so let me move to Sumit now. With FPIs now being permitted to invest in securitized paper, and also I'm assuming in the short term they should at least be in a better position to take a view on the interest rates, on the forex risk as well. So do you see this investor segment participating in the securitization market in a meaningful way, at least in the near term?
Sure. So let me address this question both wearing the hat of a banker as well as FPI investor that as Credit Suisse we are in Indian context. I think the clear answer thematically is yes, this is something where there is desire and appetite. There is desire and appetite on account of the fact that globally speaking, when we look from outside into the country perspective, securitization per se is a very large and mature market in a global context. And until this far, as an FPI investor, we haven't had the chance to look into less than 3-year tenor instruments to a large extent. And likewise, the exposures have been more towards the corporate or the GSEC. Now through this, you get the totally different asset class pool in form of exposure into the retail asset pool in Indian context, which makes it quite interesting and exciting, particularly given the macro sentiment towards India. I think, but I should caveat this, that practically speaking, and I think Mr. Khan alluded to this point earlier in his speech also, that FPIs have not really been as active still. And that's partly driven by, I would say, 3 or 4 key reasons. One is the withholding tax. And this is perpetually a challenge as to who bears that 5% implication. And in such a finely priced market, that has a serious implication. We saw that in a masala bond context also. It took a long time for that market to evolve. Eventually, I think somewhere, partly the issuers did end up kind of taking that hit of 5%. So there has to be some mental preparedness towards that. The second point, I think, was alluded here earlier, that there is some risk of prepayment or the cash flow profile is one, the duration itself is shorter, and then the cash flow profile also is a bit more staggered. And that makes, as an FPI investor, the hedging a little more complicated. So it becomes a bit more non-hedging in that sense, or at least costly on the hedging side. The third thing I would say is that, again, if you really look at from a pure pricing perspective, it does not really, given the forward curves where they are, if one were to back translate into the spread over LIBOR and look at the Indian pricing, somewhere it will be taxing for the issuer, the kind of ask, which as FPI investor, it will, for us, make sense. And the last point I would say is more towards, at times you need larger liquidity and the market to develop before you find like enough FPI interest, because there's always that desire that you're not a natural held to maturity investor, and therefore the ability to trade in and trade out, which I think we have seen. Again, I don't want to draw too much parallel to masala bonds also, but it took off. But at the same time, there were some of these similar kind of issues which did like somewhere pull back that initial excitement.
So my next question is to Mr. Vajanathan. So public sector banks, we've seen they've been fairly active in the direct assignment space, and this is despite no credit enhancement in these transactions. So the credit risk is borne by the buyer, and also we've seen that the pricing still tends to be fine, especially if it's a PSL transaction. So why do you think that this kind of transactions make it are they so attractive for the public sector banks?
Yeah, you see, we look at this securitization as a very good business model, and maybe when we enter into a transaction, maybe on different at different point of time the objective will be different. But as you know, we are very new entrants in the securitization market. Maybe just 2 years. And when we entered, yes, our objective was different. We wanted to enter the market. But as we have been having these transactions with the various players in the industry, the objectives are changing. For example, in 2015, the priority sector lending, even for home loans, changed. And that definitely actually altered the PSL ratio of the whole bank. As you know, for our bank, which is having very large corporate loan book, and also being the largest auto loan lenders, we have a large auto loan book as well, and also personal loan book. So that puts a lot of pressure on the remaining sectors like home loan and agriculture segment. So given the huge requirement of priority sector portfolio, we definitely are very keen. And this also provides for, you see, securitization a good avenue for collaboration. So maybe, you see, in some areas we may be competing, and there are, and this area maybe we can collaborate with those who can join hands. Yeah.
But once there is some pickup that is seen in the corporate loan market, do you think that the appetite for retail loan acquisitions that will come down, or that should remain strong?
See, here I will agree with Mr. Ashwini Kumar. If the credit growth picks up, and definitely what we are talking about is credit growth in corporate books.
Right.
If that picks up, then that will put further more pressure on PSL requirement. And definitely again, the same thing, the market for PSL pool will further go up.
Right.
Yeah. And again depends upon, maybe when that situation comes, maybe because we have that reach. We have reach in tier 2, 3, 4 in all the centers. Why not we look at producing and selling also? Okay, so maybe even we don't know when the situation comes. We ourselves, if we are comfortable in meeting our own priority sector lending, the situation why we will be in securitization market, the purpose may change, the objective may change. Yeah, we may be a seller also.
So let me come back to Nihas. So Nihas, under the new accounting standards, there is again one view that possibly derecognition of the asset from the books of the seller, that may become an issue simply because credit enhancements are in Indian context, they're provided by the originator itself. And because of the high rating, typically they tend to be a multiple over the expected loss that one would have, the expectation that one would have for the pool. So is there substantial transfer of risk and reward to the buyer? In that context, do you think asset derecognition from the new accounting standard perspective, would that be possible? And if not, if for some reason the assets need to be consolidated on the books of the seller, then the very concept of whether the assets are bankruptcy removed from the other creditors of the originator, can that assumption itself be challenged?
Sure. So I think the first part of the question, whether the new accounting standard will kind of change the way we account for transactions where we're giving credit enhancement, I would think the answer is no. The reason being that the principle of derecognition is that if I've transferred substantially all risks and rewards, I can derecognize the asset. If I have not transferred, of course I cannot derecognize it. If I've somewhat transferred, then the test is about whether I retain control over the asset. So this is the three tests. So the first thing, where I've transferred substantial, there's absolutely no doubt. Where I've not transferred, there's no doubt. If we cannot say that substantial risks and rewards have been transferred, and we come to even the third category, which is some risks and rewards have been transferred, but some has been retained. It's still the test is whether we control the asset which has been securitized. And we'll never pass that test in any of our securitization transactions, because the asset is never controlled by the originator, it's always controlled by the trust. And the originator has no say in how the trust functions. So therefore, the control test will never be met. Now, that is one part of it. The second part is, I think we'll always meet the test of substantial risks and rewards being transferred, because even under securitizing guideline, the maximum credit support you can give is 20%. So I've transferred 80% of the credit risk. If someone were to take a view that that is not a substantial transfer of risk and reward, I would think that's a little bit of a weak argument. And the strongest case for this is if you look at AS 30, which was the old accounting standard, paragraph 19 had the same requirements for derecognition. So even under the earlier regime, the same requirements were there vis-a-vis how derecognition happens. And there was no conflict between that and how credit enhancement was given and how people accounted for it under RBI guidelines. So therefore, I think, just because the Ind-AS has now come out and it's new guideline, I don't think the interpretation is going to change that vastly. That's first part of the question. Second part, if it ever has to get consolidated, there's no concept then of a true sale, so to say. Because if the asset is on your books, then there's no question of it being bankruptcy remote at all.
So your own view is that as long as the credit enhancement is within the 20% limit, which anyway is required for the true sale criteria to be met, derecognition should be possible.
Yeah, that will always mean that substantial risks and rewards have been transferred. Now, assume that it's even over 20%. I still think the test is, you've still transferred some risk and reward. The test is then, do you control that asset? So then, if you can at least establish that you don't control the asset in that situation, you still get a derecognition benefit. And even if it's shown you control the asset, then your recognition or how much you have to provide for, it's only to that part of the asset which you control. So it's a proportionate recognition. So that's what the Ind-AS provides. So.
Okay. Oh, that's good to hear. So let me come back to Prasann. Let's talk about the CMBS market. So again, this is one market where the issuance volumes continue to remain low. So in your opinion, what is it that could help develop this market? Is it because the LRD rates are very competitive? What are the reasons why this market has not taken off?
Frankly, we haven't seen too many issuances on this. One reason could obviously be the pricing at which the issuer is really looking at. Second is the way some of the transactions which came to the market was structured. If you look at it, there was no amortization of principal which was really happening. So there was a complete refinancing risk at the end of the term of the CMBS. Now, as an investor, frankly, that is not a risk I am willing to take for the kind of spread which was being given to me. So that is one broad reason why it hasn't really taken off. Frankly, I would say that REITs would be a better structure to really look at. But even that, we haven't really seen any major transactions coming through. I think the basic issue remains the pricing. At the pricing which some of these transactions are likely to come through, as an investor, you don't really have the kind of interest you would have. And that is the challenge I think will continue to remain given the competitiveness of the pricing which is available alternative to the issuer, and also the avenues which are available to the investor to really look at alternative from these kind of assets. So I think it's a bit of a chicken and egg situation. Where do we start from? But hopefully, as the markets mature and as the developers need to look for more and more avenues to raise money, I think this should develop as an asset class. Conceptually, again, as I said, these are some of the asset classes we're very happy to look at. Whether it's CMBS or whether it's REITs, InvITs, these are something as insurance companies we are continuing to look for longer term assets. This will clearly fall into those categories, but somewhere it has to be reasonably attractive, and some of the structural issues, as I mentioned, the way these transactions have been structured in the past need to be sorted out. I don't see any other reason really why these won't take off.
Ashwini, you want to give the perspective from the issue side as well on this?
So we were fortunate to be part of the first CMBS transaction that happened. Of course, it was done by DLF, but both the assets which were two malls in Delhi were mortgaged to us as lease rent discounting. And clearly, when we understood that transaction, one thing I noticed was that rating agencies are fairly conservative. So Prasun didn't talk about that because he's happy to have them more conservative. But from an issuer's perspective, to get even AA rating for that transaction, the cover sought was almost 2 times. So you would have almost 2 times the rent, whatever is rent. Only 50% of that can go towards servicing of interest, and whatever amount that comes to is the amount you get under CMBS. So it's a fabulous transaction structure from people who want to raise liquidity through CMBS. Developers are largely holders of these rental assets in the country, and it's a very good structure in the sense that you only pay interest for whatever 5-year period. You get 2-year period for in case you can't refinance. So there is that period after which, if you can't refinance, those shares of that SPV are pledged. You can easily take over that SPV and start the process of selling that. So I think from a structure perspective, while there is no principal amortization, as an observer in the market, I'll be very comfortable with the structure. That's how it is globally structured, and it's a kind of a $200 billion annual market in US. So clearly it can be very big. The other thing I noticed while DLF was struggling to give asset for a CMBS was that very few owners of these assets have these assets in SPV structure. And it is very important for a CMBS structure that this asset does not have any other asset, this asset SPV should not have other assets also in the same SPV. Otherwise, you can't do a CMBS around that single property. So most of the developers historically have had all their rental asset in one company. For example, even DLF, other assets, the rental assets in their IT parks and commercial buildings were housed as part of DLF assets. So there were no separate SPV for each single property. Now, once the REITs and the CMBS are a reality in Indian developed market, people are planning to have each asset in a separate SPV. So there is more flexibility doing these transactions. But currently the stock that is there, which can be conveniently CMBS or REIT can be done, are very far and few in between. So there is generally a lesser number of transactions. Third point, Vibhor, you made about an LRD as an alternative. Definitely Indian banks, especially the public sector banks, have made it very attractive for a developer to actually go for a LRD transaction than a CMBS, because the rate that are being offered today, for example, you can, with some follow-up or perseverance, you can get a rate of 8.5% or even 8.3% in the lease rental discounting market, whereas let's say what Prasun would look at would be more like a AA transaction at around 8.5%, more like 9%, and it's a fixed rate market. So anybody who has issued CMBS over last 3 years is actually feeling bad right now because interest rates have come down a lot. So if you had done a LRD, you would have taken advantage of newer rates, but you are stuck at whatever 10% or thereabout. Most of the transaction in CMBS happened. So these are some of the things which are a constraint. It's yes, chicken and egg situation, but I think these are very quality transactions which can come to the market if rates are alluring to a developer. The structure definitely it leaves lot more cash in hand of a developer, so he'll be definitely attracted. And since these are early days, my sense is as debt market in generally develop, and Mr. H.R. Khan also mentioned, and we saw in ICRA presentation also that somewhere inflection point has come for the debt capital market. And as more and more Indians discover the tax efficiency and a better yield in a disintermediated market, there would be a demand naturally created for products like these. So my sense is CMBS should see a healthy market in near future, and especially when interest rates are seemingly about to rise, there should be a lot of interest from the asset owners to raise money in a fixed rate structure through CMBS. So going forward, there's a bright future. As of now, the market is not so hot.
Thank you. So I think we are constrained for time. So I'll just squeeze in one more question before I move to the audience for the Q&A session. So this will be to Mr. Bala. So debt mutual fund investors' investments are obviously subject to issuer and sectoral level caps. Now, if I am investing in a Shriram Transport Finance originated pool, really speaking, my exposure is on the underlying obligors or part of the pool. So it's really the truck operators which are there. So is there clarity whether that investment would count towards the issuer level exposure and the NBFC exposure? And what can be addressed done to address that situation?
No, as far as the regulatory restriction concerned, there is none. It is not looking at the issuer of the PTC from a point of view of counting the exposure norms. It's always considered the underlying diversified pool, and each of the SPV is counted as a single exposure. If you have the same SPVs, multiple exposure, up to say 20% of the portfolio, and right now is 12% of the portfolio of single security, subject to board approval. So that should not be applicable for this, because in the previous regime, when the securities paper market used to be active, we all used to run a single portfolio with 100% securitized instruments. But having said that, we need to also take cognizance of the fact that regulation also got evolved in the last few years with respect to putting some restrictions on how much of the exposure the MF industries can take, let's say in NBFCs and HFCs together. And they want the extent of defining maximum of 40% exposure can be taken to the HFC and NBFC together. Therefore, if you apply the same principle, probably it is the duty of mutual funds to apply some kind of caution while constructing the portfolio, keeping some kind of benchmark as to what should be the maximum exposure one can take into the securities paper market. But as per the regulation, there is absolutely no restriction. And maybe if all of us do many schemes of this kind with 100% exposure securities paper, maybe the regulations will evolve. In order to avoid that kind of incidents, it's better we actually apply some principles around what is existing already in the NBFC and HFC kind of exposure.
So thanks everyone. So I think we can move to the audience questions now. So if anybody wants to ask the panelists anything, please raise your hand.
Nobody's asking questions.
Sure.
My audience is transparent because I have already spoken. It is by default only. No, just quickly, maybe our friend from Wadia and Gandhi can tell others. No, how do you see the prospect of a covered bond, particularly from the point of view of insolvency protection in Indian context? So is there a case for covered bond in India, or the market space is still already too many products, too much confusion, or we can go for covered bonds?
So covered bond as a product is something that will be very interesting and very, required in the Indian situation, something that can help a lot of the NBFCs and financial institutions to kind of get better rated bonds out there. However, the problem is everywhere where covered bonds have been successfully issued, you've had some level of regulatory interference to kind of ring fence the assets which are part of the covered bond structure. And in India, there's no separate regulation for that currently. However, the new bankruptcy code has a specific provision which says that you can notify certain assets which will be ring-fenced from bankruptcy. So hopefully the regulators can move in a direction which kind of uses that clause and kind of ring-fences covered bond assets. Because the moment you can ring-fence covered bond assets, then those transactions will happen. I mean, even without that, there were multiple issuers and arrangers who wanted to go ahead with the transaction. With some, they've taken some, legal protection, etc., all of that. So people are interested. There is a scope for that market. It's just, I mean, if that final regulatory hurdle could be crossed, I would think that, there would be a lot many transactions on that front.
Anyone else wants to ask a question? Okay, so since there are no further questions from the audience, that brings us, I guess, to the end of the panel discussion. So please join me in giving a big round of applause to all the panelists.